Welcome to Merill Talks, the channel where we discuss everything from global economics to the stock market. Following the success of our previous video on fixed income, an asset of choice at the moment, it is time to discuss the current macroeconomic landscape. Thank you to our audience for their constant support. We appreciate it. Do not hesitate to visit our LinkedIn page as well as our website, MerillFunds.com. Today, Marc will be with us as usual to decipher the current macroeconomic landscape. Welcome, Marc.
Thank you very much, Mike. Thank you to our audience also.
Even if it is your first time with us, Marc has managed money for over 2 decades, from Geneva to London, and now from Valletta here in Malta. Before we start our journey, please note that later on at the end of the video, the disclaimer will pop up for a few seconds, and we can get started. So, my first question for the day. You wrote an article in September 2022, Marc, about the US being the last domino to fall. Considering where we are now, what do you have to say about this?
Yes, thank you, Mike. Like I say, I wrote this article back to September 2022 when I tried to explain how resilient is the US economy. It still remained quite resilient. So for a lot of the people, they don't understand why suddenly the Fed cut the rate with a jumbo cut, which is 50 basis points, instead of the traditional, I would say, 25 basis points. Why no progression here? I think there is also a political debate. Why I'm saying this? Because you can always have the perceptions on the bottle half full or half empty. I'm saying this because, for example, the Fed chairman, Jerome Powell, said the economy is in good shape, but we decided, because we are data-driven, to cut the rate. When on the other side, Donald Trump, as we know, always quite vocal, say the bottle is half empty because the Democrats didn't manage well and the economy is in an emergency to cut the rate. So obviously here, the signal is not so clear, but obviously political debate, Republican versus Democrat, and we know elections is really around the corner in November. Now to come back on why these progressions is not clearly here, I think since 2020, since the pandemic and when the massive stimulus was synchronized with all the central banks, the message is quite different. Why? Because we call the Fed put, and it's a strong message to the investors. What Wall Street or the investor have been expecting, Powell delivered. And that's why it's very interesting. And that's why we say it's a Fed put. It's a problem, I will say. Why? Because instead of thinking about the progressions, we can expect a central bank to be more progressive. I think the US economy is very resilient and probably the last domino to fall. But I'm not so sure it's a good message. Some people will tell you, no, because they didn't cut in July, so finally they decided to cut in one shot in September. But it's debatable.
So, Marc, now that we're on the current macroeconomic landscape, can we have some final comments in general about what we are seeing at the moment?
Yes, I mean, you can see here on the screen the policy rate, and also what's the change in policy rate in 2024. As we know, US cut 50 basis points, like I said, a jumbo cut. UK, very prudent on that side, cut 25 basis points. So I would say 2 changes here. Norway, what's interesting, but we'll discuss later, 4.5, 0 cut, but still remain dovish. Australia, it's an interesting case because Australia is at 4.35. And as we know, they have been very hawkish. But what happened with Japan, they stay put. They didn't increase their rate even if they wanted in August. Now Canada, they have been cutting in a very aggressive way, 3 times I would say, ultra dovish. Germany, when we say Germany, of course, we're talking about ECB in this case, twice they cut. Sweden, as you know, Sweden is outside, it's a part of Europe, but it's outside of the ECB. So an interesting case also because Sweden cut 3 times. So the policy rate is at 3.25. So it's below now Germany. And what is interesting with Sweden, it's the rate are low, but the inflation is high. So they're in the position of cutting rate even if the inflation remained quite sticky and high. Now, Switzerland also an interesting case outside of the ECB, cut 3 times, also quite aggressive. So now 75 basis points, the policy rate 1.35, and obviously at the bottom of our list we got Japan with 25 basis points, who are hawkish, who are going in the same directions than Australia, and we know what happened in August. We did a video on it, and 2 hikes. Now they say hawkish, but I think they try to give a dovish signals. So this is where we stand at the moment worldwide for the developed market interest rate cycle.
Thank you, Marc. Let's move on to Europe. You've been negative on Germany for the last 2 years. What do you have to say about that?
Yes, Mike. Before we go to Germany, I just want to put a little bit emphasis on the stage in interest rate cycle here. And obviously, as we know, Germany, it's under the Eurozone. As we know, ECB is quite advanced on the cycle side, like the Swiss, the Swedish, and the Canadians. Now, as we know, the Fed, England, and recently China, they are still in the middle when Norway didn't move. And as we know, Bank of Japan hike, Royal Reserve Bank of Australia is looking to hike, and actually an interesting thing, Brazil hike. So yes, back to the economy in Germany. I will say to our audience, if you are interested, you can watch this video, Driving the Change. And we know, against Volkswagen announced a problem, profit warning, Stellantis. Honestly, the automobile sectors in Europe is in big trouble. Not only Volkswagen, Stellantis, but also Mercedes-Benz. They completely missed the electrical vehicle revolutions. So clearly, we are not in good shape. When you think about France, they just get a prime minister not a long time ago. If you think about these 2 engines who have been here in the middle of the construction of the European constructions, I will say they are in the middle of a trouble, and Germany, but also France. So I will say it's not maybe here we need to find some value, but we should look more on certain countries who are in the Eurozone, but they are not a part of Europe.
So, Marc, as we know, Norway is a very strong conviction of ours. We actually, in fact, released a video on Norway, and it's a strong part of the holdings of our funds. Any opinions on this?
As you know, we have been strong on Norway. There is several reasons. One of the major reasons, it's outside of the ECB. So the central bank there has his own policy, put on all these rates when the rest of Europe cutting, especially aggressively cutting. I'm talking about the neighbor, the Swedish central bank, the Riksbank. Now, beyond that, beyond the central bank activity, I think it's very interesting also because the economy is quite resilient like U.S. If you think about the GDP per capita, it's far way higher than U.S. The unemployment is quite low. I think they really navigate quite well. And when you have one of the biggest sovereign funds, I mean, of course you can navigate. It's a small nation. Just to remind you, it's 5 million inhabitants. So I think it's very interesting. Why? It's interesting because the currency, the Norwegian krone, as we know, is linked to the trajectory of the Brent, so the oil, the Northern Sea oil. But it was weak for the past 2 years against the euro, for example, trading above 12 at certain moments, trading now at 11.70, 75. And I think this weakness, it's not justified. And it's even a mystery, I will say, on that side. And that's why we like it. We like it because we like to invest in this type of country who are quite resilient. We are, as you know, a conviction fund manager here. So I think we need to put emphasis on the country we like.
So, Marc, you speak about Norway being one of the major convictions. How have you used this inside of our funds?
Just to give you an illustration here, and it's not a recommendation, but the construction in one of our funds here, you can see that the Norwegian kroner delivers 6.79%. when our U.S. exposure, it's just for you to know, it's the base currency of the funds is dollar. So as we can see here, dollar offer just below 5%. I think also a very attractive currency at the moment is the Australian dollar, 4.76, the GBP, and obviously euro now just at 3.76. That's the aggregations of the yield to us on all exposure based in euro, on the investment grade, but also on the high yield, and at the bottom of the list, the Singapore dollar. But as you can see, the NOK for us offer a very interesting things. And I want, for the audience to know, I want to speak about a little bit how we do and how we hedge. Just to give you an idea here, it's our currency breakdown. And as you can see, it's dominant. It's nearly more than 62% in dollar because the currency base is the dollar. But if you remember, we like also euro, and it's representing around, I will say, nearly 23%. Why? Because we prefer the European high yield and the US high yield because of a diversification side. But as you can see, on the third place, we have the Norwegian krone here at 5.75. So you see, we believe on this. Now, what you have to know, we have a hedge in place, but we don't have any hedge in place with the Norwegian krone. We have a hedge in place with the euro versus the dollar, around 95%. My background back at that time, I was on the corporate side hedging. I think we are doing an active management and an active hedging on our exposure. Some currency we like to hedge, which is the euro dollar, because as we can see, when you have more than 23% in euro, it's important to have an active management. But on the NOK, the Singapore dollar, the sterling, we like to let the things go because we think we like the currency, we like the NOK, we think is an undervalued currency like the Australian dollar. So clearly here, we let the things go when on the euro dollar, we are at the moment 95% hedge. We think probably the dollar is a little bit on the value. I know a lot of people saying they will have maybe an aggressive cut rate. We will see the elections coming. We will see if they will have a progressive message. In November, they will cut 25 or they will go against for another jumbo cut of 50. But nevertheless, I think so far the dollar is still, I will say, resilient. The U.S. economy is still in good shape. That's why we like to do this way.
So, Marc, we're currently looking at a massive stimulus from China. Any opinions about this?
I mean, clearly China react, but the thing is, that's the problem. We are like facing a domino effect. Why I'm saying this? Suddenly, the central bank of U.S., the Fed, cut the rate with a jumbo rate, forcing in the way the rest of the world also to act. I'm saying this because China was quite reluctant at certain moment before the Fed cut. So clearly here we have a domino effect also in China, creating a stimulus. And I think we will also be not so surprised about the ECB. ECB is quite a central bank, quite passive. The Fed, we could ask also the questions, but they're always telling you we are data driven. But I think in the way, by cutting the rate by a jumbo rate of 50 basis points, it was creating a domino effect. And clearly here probably the next one will be the ECB. But clearly the China has to do something. We know that the economy is not in such a good shape. They are facing issue on the real estate side, and that's what happened. So following this stimulus, it was incredible because the stock market, so the Chinese stock market, went like up like 6 to 7 standard deviations, which is like insane, clearly insane. They are pumping also liquidity. We didn't speak about this, but I think it's not only at the rate level, the things happening, but it's also on the liquidity side and on the easing side. For the moment, no liquidity is coming for the Fed side, but China is cutting the rate and also actively easing and try to reactivate the things. So I think maybe the bad news are over for China. It's difficult to say, but clearly here, the past few weeks after the stimulus happened, luxury brand in France went to the moon, copper went to the moon, and obviously the Chinese stock. So all this Chinese proxy went to the moon. So clearly, again, when Fed is doing something, US remain a dominant player, not only with its currency, but with the actions of its central bank.
Great, Mark, great. What I'm also very curious about, and I'd like to hear your opinion about, is we're in a very special time at the moment where fixed income has suddenly become quite an interesting asset class. What do you think about this and the timing for fixed income?
I mean, Mike, last time we did this video about, say, fixed income is the asset of choice. I think more and more people are vocal, especially in US. The vanguard of the ETF, they always speak about this, and the CEO spoke about this last week, saying that he wants to really enter into the fixed income space. I think there is a lot of inefficiency on the ETF side. Us, as an active fund manager, we think we can bring value added on that space, and we continue through the years, since our funds, who are nearly approaching, all our funds are more than 5 years of track record. So clearly here, there is a trend, and in US the trend, I mean, it's not a surprise. I mean, the stock market, it's quite topish at the moment. Everyone is nervous, especially if you think about the CEO, for example, of NVIDIA, the star of these past 2 years, is starting to sell his shares. So everyone is nervous, especially in the tech space. So clearly here, I will say fixed income is probably here at a moment like triggered by the current conditions. Interest rate will go down for sure. This is clearly the trend. Now, which asset to select? You want equity, you want fixed income. Clearly, when you have something we have been pushing so high, I'm talking about the equity market, you tend to think as an investor, it could be the right moment to think a little bit about to invest in the fixed income space. And this is clearly what we believe here, even if we like the equity market, don't get me wrong here, but I think it's becoming more and more, and probably autumn is coming, and fixed income could be the rising star for the months to come.
Brilliant, Mark. Thank you very much, as always, for the chat. I hope everybody that is watching enjoyed. Please do visit our LinkedIn page and even maybe our website if you'd like to. The disclaimer will pop up now as the video ends, and I look forward to the next video. Thank you very much.
Thank you very much, and see you.